Hey traders and investors, it's Serge Berger here. Today what I want to have a look at is the question that I've been asked a lot over the past week and a half or so, and that is it really time to short the market, or at least sort of get out of a lot of the long positions? And to look at that, let me just give you a little bit of perspective on sort of the charts currently in play. We're going to do this very basic because I really believe keeping it simple is the best way of actually being able to stick to our rules in terms of trading and investing. So let's have a look at the S&P 500 here. No brain surgery. You can see a chart moving from the lower left to the upper right hand corner. Here, if we flip it back to in this case, this is late 2011, which is sort of when the the last major sort of correction took place. Ever since then, really, we've bought every single dip, particularly since late 2012. So a little more than a year ago, year and 2-3 months ago. Really, it's been very difficult for anyone to make money on the short side. So, from that point of view, let's just look at some very simple trend lines, okay? And if you connect the bottom of 2012 with the rest of the lows from last year, you pretty much, without too much trouble, get right to where we are right now as an important support area. Okay. Also, the 100-day moving average, which is this blue line that you may not be able to see underneath the thick line I just drew, also happens to come in right here, right now. So that's important to notice. It basically means there is an area of confluence support. Something that I talk about a lot to my clients and Trade Alert subscribers. So you can see that's also coinciding with lateral support here. It's all coming in somewhere near 1770. It just a couple weeks ago was closer to 1760, where the better support was. Now really 1770 is a really good area for support. So it doesn't then take too much imagination to see that there is a possible head and shoulders pattern beginning to develop. In other words, you have a left shoulder here, a head or double top as well, and then a right shoulder. So to answer the question very quickly, basically until we break support, until we break below 1770, this market still stands a very good chance of rallying. Okay, so for my part, yes, I've begun to trade the tape a little bit more both ways again, long positions and short positions. But for the most part, I'm not leaning out any windows to really short this market. There are too many things that are still intact. If we consider the possible scenario where the stock market actually does begin to break down and the S&P were to drop below the 1770 area, then a next pretty logical target comes in just somewhere around the 1700 area, maybe a little bit above, maybe a little bit below. But it coincides with a rising 200-day moving average, which we haven't touched in ages. Okay, so a move below the 1770 area would also break the 100-day moving average and all this support I just talked about, and has a pretty good likelihood of getting us towards 1700. So I hope this makes sense. Any questions, please ask. Take care.